As a father of two teenagers, I invest in a way to help mitigate risk as much as possible. What I love about real estate is that there are numerous ways that you can choose to ensure that your investment fits your particular risk profile. Now, there are four main real estate strategies that we're going to discuss in this video, and I'm going to highlight the one that I like the most. If you're new here, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to get you out of the rat race with passive income. You can download the passive income guide I've got for you below this video. Now, up until this point, the majority of the real estate syndication deals that I've been invested in have been in what's called the value add class, which are currently my favorite. So I didn't make you watch the end of the video to tell you my favorite one. There you go. So these value add, these are similar to the fix and flip model, where basically a sponsor group, they're the ones that go out and they find the asset, like let's say an apartment complex. So they find an apartment complex with an upside potential needing rehab. But instead of renovating one unit, we're talking about multiple units, with one unit with the fix and flip. But with this, we're talking about multiple units depending on how large the apartment complex actually is. Besides value add, there's three other real estate investment strategies used to classify the risk and return profile in a multifamily property, but we're going to discuss all four. So let's get into it. The first one is what's called a core investment strategy. Now, what I want you to do is I want you to think of core in real estate as income would be in the stock market. So this particular strategy is for those looking for a stable, conservative return with minimum to low risk. All right. So these properties are high quality, low risk assets, and typically they offer the most stable cash flows available. Now, a typical core investment is characterized by having low amount of leverage, around 40 to 50%, new or light new construction. Again, stable income. They're located in an excellent area. They are very high occupancy, so they're near full to completely full occupancy. These properties are, since they're newer, they have the higher end finishes, and you can expect anywhere from 4 on the low end to 8% annual returns. And also these properties, there's no major renovations or any type of operational issues needed. Again, due to the low risk profile, you can expect about a 4 to 8% return. Most of this is likely to be generated through cash flow from the property rather than the property appreciating, because again, it's already a very new construction. Now, some examples of this would be Class A multifamily assets. Again, these are newer multifamily assets, high-end retail shopping center, and like a CVS or a Walgreens store with a 30-year lease. So those are examples of core. Next, let's move on to what's called the core plus. Now, think of the core plus in real estate as you would think of a growth in income stock or mutual fund within the stock market. Now, they have a similar investment profile to the core assets in that they're also high quality and they're well occupied, situated in strong Class A or B locations. Typically, the main difference is that they offer more of an ability to increase the cash flow through some minor or light improvements, also increasing the quality of tenants and optimizing management operations. All of these things can be done to improve on, to give the ability to increase the cash flow in the property. Now, a typical core plus investment is characterized by high quality tenants. You can think of core plus in real estate again as growth in income, good location, not great location, but good location. Typically, it's about 10 to 20 years old. About 50 to 65% of it is typically leveraged. Again, has a stable income like the core properties. Slightly dated finishes because, again, it's a little bit older. And regarding the occupancy, typically low to moderate vacancy rates can be seen. Now, due to the slightly higher risk profile, investors within the Core Plus category can expect annual returns anywhere between 8 to 12%, again, through a combination of income and growth. All right. An example of this would be like a 200 unit multifamily apartment complex situated, let's say it's situated in a growing area in Houston, Texas, submarket, built 10, 13 years ago or so. So this property, this particular example is going to be one that's well occupied. It's going to be one that's in need of light upgrades, plus maybe a little bit stronger management to help lower the expenses and increase the tenant retention. Now, this particular property is going to be one that's going to produce ample cash flow, but some of the cash is going to be used for future deferred maintenance, such as maybe it needs a new roof or parking lot repairs. So this would be an example, again, of a core plus investment strategy. As I mentioned earlier, most of the syndication deals that I'm personally invested in reside in this third strategy, and that's the one that's value add. And these consist of typically Class B, B plus, and C plus properties. The typical value add property has their finishes are dated, fair to good location, sometimes medium to high vacancy rates, not all the time, but sometimes. And then again, there's going to be some sort of amount of deferred maintenance that's going to be needed. And the investment objectives of utilizing this strategy is purchasing the asset low enough where it can be proved upon via renovations and physical improvements to bring it up to either the core plus or the core standards. And the process of doing this, it's what's called forced depreciation. You're actually going in, you're doing the maintenance, you're doing the rehab, you're doing the remodel, you're forcing the appreciation, you're forcing that the net operating income, which is how all commercial real estate is priced on, it's priced on how much money does that building produce? What's the net operating income? Okay. So these value add investments, they tend to be a good fit for those with a moderate risk tolerance and a desire for capital growth. Typically, you can expect returns anywhere from the 10 to 15% range. Last but not least is one called the opportunistic strategy. Now, unlike the core real estate strategy, using this one, it's going to be the one that poses the highest, the most risk. Typically, opportunistic investors are looking for the highest potential returns in, quote, opportunity, which is usually property that's typically bought low with the hopes of selling very high, many times for a quick profit. Now, these properties tend to have high levels of vacancies and high amounts of debt on them, possibly needing major repairs, or depending on what type of property is, it could need just a complete repositioning strategy. So it could be, let's say, a very old warehouse that's used to store stuff and completely repositioning it into apartments or something like that. Okay. Now, also, this type of strategy, it could include ground up development with minimal to zero initial cash flow. Again, it's going to have the highest or the largest potential later once that property has been rehabbed. Now, an example of this would be an investment in the multifamily space would be new construction of apartment building. Okay, so it could be just something that's brand new. There's no tenants there, no cash flow coming in. They're saying, hey, we think this is going to be a good location. They're building it here. Now, in this example, usually large amounts of capital are going to be needed due to high construction costs, which in turn, again, hopefully attracts tenants that can pay an above average rent. The key to success in this area is using a highly successful team with experience in land development, repositioning buildings from one use to another, and or ground up developments. Even though this strategy poses the highest risk, again, with risk comes reward. It also has the potential of higher returns, potentially 20 plus percent annual returns. So think about this compared to the other strategies. Now, these types of investments tend to be a good fit for investors, again, with the highest risk tolerance and or the longest time horizons. Now, if you're looking to invest capital in commercial real estate, the strategies that we've discussed today will help you set up your risk and your return expectations. They also allow you to seek out a general partner or a sponsor group if you're like me investing in real estate syndications, to seek out a group like this whose strategy, investment objectives, and risk tolerance match your own personal ones. Now, if you want to learn more about my personal investment strategy, I'll let you in over here in this video. Check it out.